There's a tax rule changing in February 2026 that could legally allow the IRS to take up to 50% of the money sitting in certain foreign accounts owned by green card holders. And most people affected have no idea it's coming. Not because it's brand new, not because it was hidden in secret legislation, but because enforcement is about to become aggressive in a way we haven't seen before. I recently spoke with someone who had been living in the United States for nearly a decade, working hard, saving carefully, building a stable future for her family, and she thought she was doing everything right. Then she learned that a savings account she barely touched back in her home country could trigger penalties larger than the interest she had earned in years. She wasn't hiding money, she wasn't evading taxes. She simply didn't know the reporting rules applied to her, and that's the dangerous part. Because in the eyes of the IRS, not knowing doesn't protect you. As February 2026 approaches, new enforcement measures tied to foreign account reporting are tightening. Data sharing between countries is expanding, and financial institutions abroad are under more pressure than ever to disclose information about U.S. tax residents. That includes lawful permanent residents. If you have a green card, even if you plan to move back home someday, even if most of your money is overseas, even if you haven't lived in the US continuously, this affects you. And the difference between acting now and waiting could literally be thousands or even tens of thousands of dollars. Hi, I'm Sofia, and welcome back to US Visa and Immigration Update. If you're a green card holder, this is one of the most important financial updates you'll hear this year. I cover immigration and policy changes that directly impact your life here in the United States. And today, we're talking about something that sits at the intersection of immigration status and tax responsibility, a place where many permanent residents unintentionally make costly mistakes. In this video, I'm going to clearly break down what's changing in February 2026, why lawful permanent residents are uniquely exposed under these rules, and what you can do right now, not next year, not when you get around to it, but right now to protect your savings and your financial stability, because this isn't about fear. It's about awareness, preparation, and making sure everything you've worked so hard to build stays protected. Here's the rule that trips up more green card holders than almost anything else. The moment you become a lawful permanent resident, the IRS classifies you as what's called a resident alien for tax purposes. And that label changes everything because under US tax law, resident aliens are taxed on their worldwide income, not just what they earn inside the United States, not just what lands in a US bank account, but income and financial accounts anywhere in the world. It doesn't matter if the account was opened when you were a teenager. It doesn't matter if the money was earned before you ever moved to America. It doesn't matter if it just sits there untouched. If your name is on it and you hold a green card, the IRS expects you to report it. This is where the confusion begins, because many permanent residents understandably think, I'm not a US citizen yet. I still have ties back home. Surely that account in India, Brazil, Nigeria, the Philippines, Mexico, wherever it may be, isn't treated the same way. But from a tax perspective, it is, and the IRS does not separate your financial life into here and back home. It sees one global financial picture. That means foreign bank accounts, investment accounts, pensions, rental income from property overseas, business interests, even certain types of joint family accounts can all fall under reporting requirements. And here's the part that shocks people. You may not owe additional tax on those assets, especially if you already paid taxes abroad, but you still have to report them properly. Reporting and paying are two different obligations. And failing to report is where the real danger begins, especially when we talk about the $10,000 threshold that many people misunderstand. It's not $10,000 in one account. It's $10,000 combined across all foreign financial accounts at any point during the year. If the total balance across those accounts crosses that number even for a single day, you may have a filing requirement, and that requirement has existed for years. Which brings us to what's changing in February 2026. The law itself, known as FATCA, the Foreign Account Tax Compliance Act, has technically been around since 2010. So this isn't a brand new tax law being created out of nowhere. What's changing is enforcement. Over the past several years, the U.S. Treasury Department has been expanding international data sharing agreements, strengthening compliance standards for foreign financial institutions, and building more sophisticated systems to match overseas account data with U.S. tax returns. And beginning in February 2026, enhanced reporting standards will require foreign banks and investment institutions to provide more detailed information about account holders who are considered U.S. tax residents. That includes green card holders. Why does this matter so much right now? Because foreign banks that fail to comply can face severe penalties themselves, including restrictions that limit their access to the U.S. financial system. In other words, they are highly motivated to report accurately and completely for years. Enforcement was uneven. Some institutions reported inconsistently, some data slipped through gaps, some green card holders assumed if the bank hasn't contacted me, it must not apply, but that assumption becomes much riskier under the 2026 framework. Automated cross-border reporting, improved digital matching systems, and expanded international cooperation mean that discrepancies are more likely to be flagged. If your U.S. tax return shows no foreign accounts, but foreign institutions report accounts tied to your identifying information, that mismatch can trigger scrutiny. And once scrutiny begins, the conversation is no longer casual. The shift in 2026 isn't about targeting immigrants, it's about tightening global compliance systems. But green card holders are uniquely exposed because many maintain legitimate financial ties abroad. Family accounts, inherited assets, retirement plans from prior employment, property investments, none of those are illegal, none of those are wrong. But if they're not properly reported, they can become expensive problems. And the penalties attached to these reporting failures are what truly make this urgent. Now, let's talk about the part that makes people sit up straight, the penalties. Because once you understand the numbers, this stops feeling theoretical and starts feeling very real. If your combined foreign financial accounts exceed $10,000 at any point during the year, you are generally required to file what's called an FBAR, a foreign bank account report. This form is separate from your regular tax return. It doesn't mean you owe tax. It simply reports the existence and maximum balance of those accounts. But failing to file it can be extremely expensive. If the IRS determines your failure was non-willful, meaning you didn't intentionally try to hide anything, the penalty can be up to $10,000 per violation per year. Now pause and think about that. If you forgot to file for 3 years, that could potentially mean $30,000 in penalties. And that's in a non-willful situation. If the IRS believes the failure was willful, that you knowingly chose not to report, the penalty can jump to the greater of $100,000 or 50% of the account balance per violation. 50%. Imagine you have $80,000 sitting in a savings account overseas, maybe funds your parents helped you save long before you moved here. Under a willful penalty assessment, you could legally lose $40,000 of that gone. And this is not hypothetical language buried in law textbooks. These are penalties that have been assessed in real cases. What's changing in February 2026 is not the existence of these penalties. It's the increased likelihood that unreported accounts are discovered through enhanced international reporting systems. The safety net of maybe they won't see it is shrinking rapidly. And this is why awareness right now is so important. If this information is already helping you understand risks you didn't know existed, take a quick second to like this video and subscribe. I focus specifically on updates that affect green card holders and immigrants, and staying informed is one of the best ways to protect yourself before small issues turn into big ones. Now, let's keep going because bank accounts are only part of the picture. One of the biggest misconceptions I see is people thinking, well, I don't have a foreign bank account with a lot of cash, so I'm fine. But reporting requirements extend far beyond checking and savings accounts. Foreign investment accounts count. Mutual funds held overseas can count. Certain foreign retirement or pension accounts count, even if you can't access the money yet. If you inherited property back home and you rent it out, that rental income must be reported on your U.S. tax return. If you own a percentage of family property, even if you're not actively managing it, that ownership interest can create reporting obligations. If you're listed as a co-owner on a parent's account simply for convenience, that can still trigger an FBAR filing requirement. And in addition to the FBAR, some individuals must also file Form 8938 under FATCA rules if their foreign assets exceed certain thresholds which are higher than the FBAR threshold, but still easily crossed by someone with property or retirement savings abroad. The key thing to understand is this reporting does not automatically mean you owe more tax. Many green card holders qualify for foreign tax credits if they already paid taxes overseas. Many will not owe additional U.S. tax at all, but the obligation to disclose remains. The IRS wants transparency first, calculation second, and with enhanced enforcement coming in 2026, the system is becoming far better at identifying when that transparency is missing. So, if you've ever assumed that an inherited apartment, a dormant pension, or a small joint account doesn't really count, this is the moment to pause and reassess, because under US tax law, it very likely does. One of the most financially dangerous situations I see involves green card holders who believe they left the system simply because they left the United States. Maybe you lived here for 6 or 7 years, then moved back to your home country to care for family, manage a business, or simply because life changed. You stopped working in the US, you stopped earning US income, you may have even stopped filing US tax returns. But here's the critical question. Did you formally abandon your green card? Because if you didn't, if you never filed Form I-47 to officially surrender your lawful permanent resident status, then in the eyes of the IRS, you may still be considered a U.S. tax resident. That means the obligation to file annual U.S. tax returns and report worldwide income may never have stopped. I've seen cases where individuals lived outside the United States for nearly a decade, assuming everything was behind them, only to later discover that years of non-filing created exposure to back taxes, interest, and reporting penalties. And with expanded international data sharing agreements feeding more consistent information to US authorities, these situations are becoming harder to ignore. Imagine receiving a notice years after you thought you had moved on, asking for records of foreign accounts, income statements, and prior filings you never realized were required. The financial and emotional stress can be overwhelming. The key point here is simple but powerful. Immigration status and tax status are connected. As long as your green card remains active, your global financial life remains visible to U.S. tax law. And February 2026's enhanced enforcement measures increase the probability that long-standing gaps will surface. But there is still an important distinction, and this is where some relief comes in. The IRS treats voluntary compliance very differently from enforced discovery. If you act before they contact you, you often have far more options available. Now let's shift to another area that catches many green card holders completely off guard: large foreign gifts and international transfers. Suppose your parents overseas want to help you buy a home in the United States. They send you $150,000 as a gift. You deposit it into your US account. You assume it's fine because gifts are not taxable income in the US, and you're correct. Generally, you don't pay tax on gifts you receive. But what many people don't realize is that if you receive more than $100,000 from a foreign individual in a single year, you are required to report that gift on Form 30FAD20, not pay tax. Report it. If you fail to file that form, the penalty can be 5% of the gift amount per month, up to a maximum of 25% on a $150,000 gift. That could mean a $37,500 penalty simply for failing to submit an informational form. And with February 2026 bringing enhanced monitoring of cross-border transfers and stronger reporting requirements for financial institutions handling international wires, large transfers are more likely to generate data trails that align with IRS systems. This does not mean sending or receiving money internationally is illegal. You are absolutely allowed to move your own funds or receive support from family, but reporting obligations must match the transactions. The same applies if you maintain joint accounts overseas, if family members deposit money into accounts that include your name, or if you regularly transfer savings between countries. Every movement creates a record, and beginning in 2026, the systems reviewing those records become more efficient at identifying inconsistencies between what's reported by financial institutions and what appears on your tax filings. If you know other green card holders, friends, family members, coworkers who still maintain accounts or assets overseas, share this information with them. Many people are completely unaware of these reporting requirements, and a simple conversation today could prevent a serious financial problem later. Now, let's clear up one more major area of confusion that often creates unnecessary fear: the idea of double taxation and what protections actually exist. One of the biggest reasons green card holders delay dealing with foreign account reporting is because of a very understandable fear. If I report everything, Won't I get taxed twice? It feels unfair. You earned income in your home country, you paid taxes there. Why should you have to pay again in the United States? The good news is, in many cases, you don't. The US tax system includes something called the foreign tax credit. If you paid income taxes to another country on the same income, you can often claim a credit that reduces or even eliminates your US tax liability on that income. There are also tax treaties between the United States and many countries that help prevent double taxation in specific situations. But here's the crucial distinction. The protection from double taxation only works if you report the income properly and claim the credit correctly. The IRS cannot apply a credit to income it doesn't know exists. So, choosing not to report foreign income because you already paid taxes elsewhere doesn't protect you. It removes the very mechanism designed to protect you. Reporting is the foundation. Calculation comes after. In many cases, once the numbers are properly documented, green card holders discover they owe little or no additional US tax at all. The risk isn't always in the tax itself, the risk is in the failure to disclose. So, what should you actually do right now before February 2026 tightens enforcement even further? Start with clarity. Sit down and create a complete inventory of every financial asset you hold outside the United States. Every bank account, every investment account, any pension or retirement plan from prior employment, any rental property, any inherited ownership interest, any account where your name appears as an owner or co-owner, even if it primarily belongs to a parent or relative. Do not filter it. Do not assume something is too small to matter. The $10,000 FBAR threshold is an aggregate number. It adds accounts together. Once you have that list, review your past tax filings. Have FBARs been submitted each year they were required? If your foreign assets exceeded FATCA thresholds, was Form 1838 included with your tax return? If you received a foreign gift over $100,000, was Form 35/20 filed? If you're unsure what was filed, request transcripts or consult a qualified international tax professional who can review your prior returns carefully. This is not the moment for guesswork. If you discover gaps, and many people do not panic. What matters most is timing. Acting voluntarily before the IRS contacts you keeps far more resolution options open. Waiting reduces those options significantly. February 2026 does not mean automatic punishment, it means enhanced visibility. And visibility makes proactive correction far more powerful than reactive defense. The goal here is not fear, it's control. The earlier you organize, document, and if necessary, correct past filings, the stronger your position becomes. If you've been listening to all of this and thinking, I didn't know, I honestly didn't realize these forms applied to me, then this next part is especially important. The IRS understands that not every reporting failure is intentional. There is a major difference between someone deliberately hiding assets and someone who simply didn't understand the rules that come with being a U.S. tax resident. That distinction is why the IRS created what's known as the streamlined filing compliance procedures. This program is specifically designed for taxpayers whose failure to report foreign income or assets was non-willful, meaning it was due to negligence, misunderstanding, or lack of awareness, not intentional concealment. Under the streamlined program, eligible taxpayers can file amended tax returns for the most recent 3 years, submit up to 6 years of delinquent FBARs if required, pay any taxes owed plus interest, and potentially avoid the harshest penalties that would otherwise apply. For many people living inside the United States, this can mean significantly reduced or even eliminated FBAR penalties compared to what could be assessed in a standard enforcement action. But here is the critical condition. You must act before the IRS initiates contact with you. Once you receive a notice or your case is under examination, streamlined relief is generally off the table. Timing is everything, and with February 2026 bringing expanded data reporting and tighter cross-border information sharing, the window for quiet voluntary correction may narrow. That's why waiting is not a strategy. Preparation is. Now, I want to zoom out for a moment and bring this back to something bigger. Being a green card holder is a tremendous opportunity. It represents stability, access, and the ability to build a long-term future in the United States. But with that opportunity comes responsibility, and tax compliance is one of the most serious responsibilities attached to permanent resident status. The system does not operate on assumptions about what you intended. It operates on documentation. And the reality is that many permanent residents maintain deep, legitimate financial ties to their home countries. That's normal. That's human. Families remain connected, property is inherited, savings are maintained across borders. None of that is wrong. The problem only begins when those connections are invisible on your US filings. February 2026 is not a deadline in the sense that something explodes overnight. It's a shift towards stronger enforcement and more complete data matching. And in that environment, the safest position is transparency, organization, and proactive correction where necessary. The goal is not to become a tax expert. The goal is to ensure that everything you've worked hard to build, your savings, your home, your future plans, is protected from preventable penalties. Awareness gives you leverage. Action gives you protection.